साथियों, गोल्ड यानी सोने की खरीद एक और पहलू है जिसमें विदेशी मुद्रा बहुत अधिक खर्च होती है, लेकिन देश हित में हमको ये तय करना पड़ेगा कि साल भर तक घर में कोई भी फंक्शन हो, कोई भी कार्यक्रम हो, हम सोने के गहने नहीं खरीदेंगे, सोना नहीं खरीदेंगे.
That was PM Modi in Hyderabad, asking Indians for the first time in living memory to stop buying gold for a year. And the government has now followed words with action. India has sharply raised gold import duty from 6% to 15% as policymakers battle a dangerous macro cocktail. Soaring crude prices, a weakening rupee, widening current account pressures, and geopolitical instability triggered by the Iran conflict. Gold imports alone touched nearly $72 billion last year, almost 10% of India's total import bill. So in this episode, we look at three broad questions. What has actually been happening on ground with consumer demand for gold? Of course, and gold isn't just jewelry. It underpins a rapidly expanding $200 billion plus lending market. What does this policy pressure mean for gold loans? And is India actually heading towards a forex crisis, or is Prime Minister Modi's speech and this duty hike classic preventive management? Listen on, it's Thursday, the 14th of May. I'm Anirban Chowdhury. This is the Morning Brief. When a Prime Minister warns you not to buy gold and policy action is clearly coming, the rational Indian response is not to stop, it's to rush. And that's exactly what happened. Panic buying. Suvankar Sen, MD and CEO of Senco Gold, was watching it from the front lines.
What has happened is that I think consumers were looking at it as a warning, and somewhere those who had weddings in the family in the upcoming months of, say, currently in the next 2-3 days or end of June, July, or even the end of the year, I thought that they were panicked a little bit. And it was basically them who wanted to go and buy in case the government comes up with any restrictions or increases the duty and the tariffs or the taxes on gold,
What kind of increase did you see?
It went up by about 10-15% than the normal buying that happened. And then when the announcement of the duty increase happened, that kind of led to a little bit of a dampener on the enthusiasm or the panic. What I would like to clarify is, like, if you look at the April import and the May import, right? Import of gold has been on a downward trend, number one. Number two, that in the Q1, which is Jan to March of 2026, as per the report of World Gold Council, whatever import had happened, out of that, for the first time, the percentage share of import related to investments in terms of bars and coins or in terms of mutual funds, ETFs, that was higher than the import that was used for jewelry consumption. Because we need to be very clear on one part, and I think what's happening at the ground level is we have seen that the transaction that we are doing with our consumers, and not just us, it's I think across the board, across all the various jewelry companies, almost 55% of the transaction is consumers exchanging their old gold and buying their jewelry, right? We are encouraging the consumers to exchange their old gold. So that much quantity of import is getting saved. It is only the rest of the 40-45% of the transaction that is happening where the fresh imports are coming in. Plus, another point we want to make is that there is already huge quantities of gold, idle reserves lying in the economy, whether it be temple gold, some amount of household gold, some amount of household investment in the form of bars and coins, right? And also gold lying in mutual fund reserves and ETF reserves. If government and industry and the policymakers, we all come together and find out a solution to utilize the gold, almost 20,000 to 30,000 tons of gold lying in the economy in various forms. If that can be reutilized, even a part of it, that would really, really save our country from the current account deficit situation.
Suvankar, I'd like to double click on the exchange of gold bit. What are you advising customers? Also, do you see investments shifting more towards digital and paper gold?
Exchange schemes, as in we as Senco, will surely encourage more exchange schemes. Anyway, because the prices of gold has jumped so much. So we have been working on making jewelry which is lighter weight. We have been working on jewelry which is of a lower caratage. So usually, traditionally Indians have been buying 22 carat purity jewelry, right? Hallmark purity. Now we are encouraging people to buy 18 carat, 14 carat, 9 carat. That will also, make sure that lesser quantity of gold is being used in the jewelry. So, and hallmarking is there. So that is another effort and initiative we are making. That's the way to look at it.
Got it. Now, we saw gold prices spurting and going through the roof, then a correction. Now, if policy pressure builds or continues on gold imports, do you see that shaping the jewelry industry and consumer demand in the long term also, maybe over the next 1 year?
Yes, it's very confusing as to what might happen over the next 1 year, because at one end, there might be a lowering of the demand at our country's end, but at the other end, globally and geopolitically, how things would shape up in the US, how things would shape up in the Middle East. Will the crude oil prices come down? When the new Fed governor joins the Fed board, will he take a hawkish view and increase the interest rate to control inflation in the US? Or will he keep the interest rate as it is and support the industry in the US to develop? So, what kind of steps will be taken? That is something that we need to watch. And based on that, at the international level, gold prices can move up or down, irrespective of the domestic demand of our country. But all said and done, I think in the long run, gold will continue to be in an upward trend, but the short-term volatility will continue to remain.
And you see an impact on margins in this quarter because of this policy pressure?
Actually, it might just add up to the margins, because suddenly the inventory that is lying in your store shall be valued at a higher price, right? So in order to ensure sales happening, we will be doing offers and schemes and discount, but I do not see that there will be too much of a margin pressure for this quarter because of this situation.
But gold in India is not just jewelry, it's collateral, the fastest source of emergency liquidity for millions of households and small businesses. And now, just as gold loans explode into a 16 lakh crore rupees ecosystem, RBI is tightening the screws. My colleague and banking expert Atmadip Ray joins me to decode the risks, contradictions, and what this means for India's credit system. Hi, Atmadip. Very warm welcome to the Morning Brief. This is your second time on the podcast. So glad to have you.
Thank you, Anirban. Happy to join.
Right. Okay. We are talking about gold loans. Lots has been happening from the lender side, from the RBI side as well. First, take me through why gold loans have exploded over the last 2 years.
Yeah, the gold loan market is really evolving. Let me first give you some data points. Bank loans against gold jewelry surged nearly 5 times in the last 2 years to about 4.6 lakh crore. And if we take banks and non-banks overall, the total AUM now reached to 16 lakh crore. So this is basically driven by two things. One is, of course, banks and non-banks are expanding their gold loan business, and also the surging price of the yellow metal. Because as you understand, when prices are higher, you will get more loans for your same amount of gold jewelry.
Got it. Now, so the other part of the question, of course, is why is the RBI suddenly seeing risks in this market? Not suddenly, for the last 1 year.
Right. Before that, let me just take you through the psychological shift which is happening in the market.
Right.
One is very interesting. These gold loans are no longer the last resort safety net for the poor. It's increasingly used by small businesses, as a productive, high liquidity tool for working capital and bridging finance. Also, the younger generation does not hesitate to place their gold to get a quick personal loans, maybe for overseas travel, maybe for home decoration. So basically, the social taboo of pledging gold that no longer exists. Now, when there's a rapid expansion, of course, as a regulator, RBI have their concerns in place. It happens in every market. Whenever there's a rapid expansion, always the regulator comes with more guards, right? So when the market is going very strong, sometimes what happens, lender gets carried away. They weaken their due diligence. And that is why the regulator implemented a strict standardized framework from April to address these concerns. Your question is, what are the gaps in the market, right? There are deficiencies in assessing the purity of the gold when the loan being sanctioned, as well as gaps in verification of the ownership. Sometimes lenders were relying on third parties for sourcing the loans. So this lends to the poor oversight, perhaps. Also, there's another concern when a loan gets default, and if ultimately the gold is being auctioned, that time the transparency is sometimes not being maintained, which is another regulatory concern.
Right, Atmadip. We'll get to the new rules that have been implemented since April 1 in a bit. But before that, we've seen a surge in gold prices. Now, how does that really change lender behavior and risk appetite?
See, this simple mathematics is when there's a surge in gold price, this automatically translates into higher loan amount for a fixed amount of gold being pledged. Now, what happens is when prices are high, lenders play a more aggressive LTV game. LTV means loan to value ratio. Against the value of gold, percentage of loan being sanctioned. So LTV typically by Indian lenders is around 60 to 65. Although the regulators allowed it to 75% till April. After April, there has been a change, but most lenders were comfortable lending at 60 to 65. So they are conservative.
Now, Atmadip, explain to me RBI's new rules around gold lending.
So effective April 1st, the RBI has implemented a tighter and more transparent framework for gold loans. So what is the basic plan behind this? This is essentially to protect borrowers and standardize the lending practices. What are the key changes? We just explained in a bit. The LTV, as I spoke earlier, this loan to value ratio, earlier it was flat 75%. Now it is a tiered one, means up to 2.5 lakh of loans, the LTV can go up to 85%. Between 2.5 lakh to 5 lakh, the LTV would be 80%. Above 5 lakh, it would be 75%. So what essentially RBI is saying is the more you give a loan, the lower will be the LTV. That means for the higher value loan, RBI is telling lenders to exercise higher caution. That is what they are saying. Number two is now there is a mandatory 12-month maximum tenure for gold loan. So what does it mean? It means that no gold loan can be rollover and for beyond 1 year. So under this, both principal and interest must be cleared in a single payment within 1 year. What we will do? This will bring better discipline in the system.
Got it. Now, let's come to the impact. What will it do to gold lending? I think there was a story that I read today that a bank said this will have a negative impact on the amount of loans that it can disburse on gold. Why don't you explain that to me?
See, in the lending business, it is always prudent to be guarded, more so when there are uncertainties. Now the price is correcting, but eventually the price will start rising at some point. But one cannot time the market. Hence, at this time, caution is the buzzword, and banks and NBFCs both, they will remain conservative in business expansion.
So now, Atmadip, what happens to banks and also NBFCs if gold prices sharply correct from the current levels?
See, the prices have already corrected very sharply. But a good thing is, we don't see any immediate concerns because lenders typically used to keep loans value ratio below 75%. The usual practice is to keep it around 60 or 70. Now, that means unless the price corrected 25%, there is no concern.
Understood. So now finally, Atmadip, if you were to give me a broad comment on how you see this story evolving in the next few weeks or months? What are the 2, 3 things that you see happening to gold loans in the near future?
The first of all, as I said earlier, caution will be the buzzword going forward for the next 2-3 months till the time there is a clarity on the West Asia front. After that, there will be at some point when price again start rising, market will start again booming. And the big thing is the market, which was essentially a southern market, now going beyond southern market. So in the north, everybody is expanding and we are basically scratching the surface. So sky is the limit.
Fantastic. Thank you, Atmadip, for joining us.
Thank you. Pleasure.
But then this story is now about India's external stability. The rupee, imported inflation, capital outflows, and whether policymakers are moving early to avoid a larger macro shock. Now, there were 7 appeals in Modi's speech. Avoid foreign travel, work from home, carpool, skip destination weddings. The last time a prime minister spoke like this, it was COVID. The numbers behind this ask are stark. Crude has jumped nearly 50% since February, from $73 to over $105 a barrel. The main reason? War-torn Iran restricting the Strait of Hormuz, the biggest energy choke point in the world. India imports 85% of its oil. Last year's crude bill alone was $123 billion. The rupee has depreciated 10%. Forex reserves have fallen $38 billion since February to $690 billion. The IMF projects India's current account deficit at $84 billion for 2026. Bank of America sees it hitting 2.1% of GDP in FY27. Naturally, many have seen Modi's speech as a distress signal dressed as a voluntary appeal. So, I asked Madan Sabnavis, Chief Economist at Bank of Baroda, are we really facing a forex crisis?
No, I think we're very far from it. So let's try and separate the two things. See, one is we're talking in terms of an economic crisis, which actually comes across when we see foreign exchange reserves get depleted. So this is the kind of situation we had in 91, 92, when forex reserves came down drastically. We also had a similar kind of situation, though not as bad as what we saw in 91, 92 in 2013, 14. And therefore, there were certain measures which had to be taken to revive our forex reserves. Now, today we are nowhere in that kind of a situation. Our forex reserves have come down, but they're very, very healthy. I use the term healthy because normally we say that the health of the forex reserves is calculated on the basis of import cover which is available. Today we're talking still of around 10, 11 months of import cover which are there. And normally if you're less than 4, it's a crisis. 4 to 6 means you're somewhere in the middle range. 6 to 8 means, okay, we need to get slightly worried. But once we're in this thing of above 8 months of import cover, there is no question of a crisis as such in terms of the fundamentals.
Okay, so then please explain the exact vulnerabilities that we are facing right now.
See, the problem we have today is that on account of the war, we have seen that the price of crude oil has become very volatile and has tended to go above the mark of $100 per barrel. So what this has meant is that there has been pressure on the trade balance, and automatically that gets reflected in the current account balance, as well as the overall balance of payments, which then pressurizes the rupee. Because the rupee is determined by demand and supply forces. So today, when the demand for dollar is going up much higher than what it was earlier on account of a higher price of crude oil, there is a tendency for the price of the currency to get affected, which is the rupee. So that's why we have seen that the rupee has been falling. Now, this is a situation which needs to be looked at rather carefully, because a rupee depreciation on account of fundamentals is not really something which we need to be concerned about. So we do have this particular situation of higher imports putting pressure on the rupee, which is not being matched by other inflows, especially exports or remittances or anything on the capital account. Because we also have the joker in the pack, which is foreign portfolio investment flows, which tend to be negative. So I think all this has contributed to the rupee fall, and the fact that the RBI has made it very clear that it's going to intervene only when they see too much of speculative activity leading to volatility, and not really spoken of what would be the currency rate which they are looking at or targeting. I think that the rupee has continued to depreciate further. Always looking at the RBI for some kind of direction. When that's not coming, there's a tendency for the rupee to depreciate further. This is what's happening.
Got it. Now, the RBI has been taking some steps to prop up the rupee, and a lot of people have been calling them forex missteps, whereas they are actually liquidity steps. What's been happening and what's the real picture?
See, actually, let's look at it. See, the RBI has a function of looking after the monetary aspect, that is monetary policy, liquidity management. And there's also the thing called forex management. And the motivations there are quite different. But being the central bank, there has to be coordination between these two things, which is something which the RBI has been doing continuously. So now when we're talking in terms of forex management, see, the RBI has always maintained that they are not really targeting any number. But when they see there's excessive volatility, there will be also regulatory steps taken, or there could be direct intervention in the market. Like there could be spot purchase, sales of dollars. So in this kind of, when the rupee is depreciating, they could be selling dollars to make sure that the rupee stabilizes. They could be taking position in the forwards market. They could be taking position in the NDF market. Now, what all this does is that basically send a strong signal saying the RBI is aware that there is something untoward happening in the market, and therefore the RBI is getting into action. However, the RBI does not really intervene if the demand-supply factors do indicate or do justify the rupee depreciating. I don't think the RBI is going to intervene, because in any market, you cannot really fight against the market. Now, when you're talking of liquidity management, I think the RBI has the liquidity framework which says that there are certain measures which will be taken to ensure that liquidity is managed. Now, let's assume that liquidity is in deficit. That's the time when what the RBI does is they get into the forex swaps, where they buy dollars from the banks, give them liquidity. So therefore, the liquidity situation is assuaged. And this swap will mean that maybe after 1 year or 3 years, depending upon how the contract is structured, it will be given back to the bank. Now, what really happens in this kind of a situation, this is besides the open market operations and the VRR, VRRR, which the RBI conducts as part of the liquidity framework. So we need to separate the two issues. And the RBI has also made it clear that whenever dollars are withdrawn from the market in terms of the forex swaps, which were used to induce liquidity, and if you're doing a reverse kind of a transaction, you're selling dollars, you're automatically using an open market operation or a VRR to ensure that liquidity is provided. And at times when the RBI feels there's too much happening in the market, there's no need to buy or go in for forward contracts, there could be a regulatory change which could take place, like what they did for the open positions in the NDF market, which they capped at $100 million. So I think there's a close coordination between these two departments, and I think it has been done in a very, very seamless manner. And I don't see any reason for anybody to have doubts about these things being contradictory. Everything is happening in the similar direction.
Going forward, what policy tools does the central bank realistically have if, imported inflation and the rupee pressure intensify together?
See, if the rupee keeps depreciating, yes, there will be imported inflation, in which case, when the moment you go into monetary policy, there is a case of saying that any kind of hope of interest rate cuts will actually disappear. We can only be talking of status quo or maybe an increase in the repo rate at some point of time if the inflation number really turns out to be nasty. So that is something which the RBI will have to do on the monetary side. And on the currency side, the very fact that we are seeing less intervention of the RBI, I would tend to think that maybe the RBI believes that selling dollars in the market at this point of time may not really serve any purpose. I may probably be able to stabilize the rupee for a couple of days, and after that we may again go towards the 96 mark. So how much of our reserves can we draw down to defend the rupee when it's actually moving because driven by fundamentals? Presently, I think if the RBI is not intervening in the market, we can probably assume that the rupee is going to continue to depreciate, and that would probably be a fair thing in a market-driven economy.
Understood. Madan, thank you so much for joining us.
Yeah, no.
Modi's gold appeal, a duty hike, tighter gold loan rules, the rupee under pressure. This is India managing a foreign exchange squeeze in real time, using every lever it has. The next few months will tell us if that's enough. That's it for today. You were listening to this episode on The Morning Brief. It was produced by me, sound designed by Radhas Naik. Do listen to The Morning Brief and our other shows, including Corner Office Conversation, wherever you get your podcasts. The external clip used in this episode belongs to its owner. Credits are mentioned in the description.